The Fed just crashed the market as the interest rate rises. No one is safe from inflation in the Fed, as it is coming for every market. You may be wondering how the recent interest rate hike will affect the markets. Moreover, for how much longer will the market be affected by the current rate of increase? Don't worry, we're here to answer all these questions. In this video, we'll talk about the effects of an increase in interest rates by the Fed on the financial markets. So stay tuned and watch this video till the end. Following its meeting on September 20th and 21st, the Federal Reserve declared that it would increase its target range for the federal funds rate to between 3.0 and 3.25%, an increase of 0.75 percentage points. To slow rising inflation, the Federal Reserve has hiked interest rates for the third time in a row, this time by 75 basis points. The Federal Reserve took this action because annual inflation in the United States reached 8.3% in August, prompting the Fed to act. Let's see how this increase is affecting different financial markets. We start with number 1, the real estate market. Mortgage rates are more sensitive to the yield on the 10-year Treasury note than to the federal funds rate, but they nevertheless tend to follow the same general trends. In the past few months, mortgage rates have skyrocketed along with the 10-year Treasury yield. This is because the market expects the Fed to raise the Fed funds rate by a lot. Potential homebuyers have been hit twice by the recent increase in interest rates and the substantial increase in property costs over the last few years. Both home prices and the cost of financing them have increased, which has slowed the housing market. Mortgage rates have risen to their highest levels since 2008. Inflation has not demonstrated any meaningful slowdown, so it is still unclear when the Fed will stop hiking interest rates and for how long. The Federal Reserve's decision to speed up the runoff of its balance sheet is one reason why mortgage rates have been going up recently. The rate of a home equity line of credit, or HELOC, rises with the federal funds rate because of how sensitive they are to interest rate fluctuations. HELOCs are often linked to the prime interest rate, which is the rate charged to a bank's best customers. Rates for those who still owe money on their HELOC will rise. Rate increases can present an opportunity to shop around for a better deal. Rates have been rising, and it's expected that they'll continue to do so throughout the year. This means that people who still owe money on their HELOCs may anticipate their payments going up. Thus, for the time being, rising rates are rapidly decreasing housing affordability. 2. Savings accounts and CDs. As interest rates rise, banks will raise the interest rates on savings and money market accounts. The rate at which this happens will vary from bank to bank. If you invest in the correct places, rising rates might be excellent for your savings. The best yielding national savings accounts and CDs have risen significantly since the beginning of the year and are now at their highest possible level since 2009. Earning 2.5% or 3% isn't very thrilling when inflation is 8%, but if rates continue to rise, it's good news for savers, since it will increase returns and eventually bring inflation down. Those who recently locked in CD rates will be able to keep those rates for the life of the CD, as long as they don't withdraw their money early and pay a penalty. If you're a saver trying to earn the most interest possible, your best chance is to open an account with one of the best credit unions or best online banks. 3. Stock and cryptocurrency investors. As long as the Fed maintained interest rates at or around zero, the stock market increased. Stocks benefited from low rates, which made them appear more attractive as an investment compared to bonds and other fixed income products like CDs. Yet, times have shifted. The S&P 500 has been in a severe downtrend during all of 2022 due to investors pricing in rate increases from late 2021. And now that rates are going up, people are asking how low stock prices can drop and how high they can go. Despite the old saying, "Don't fight the Fed," investors have been betting for months that the central bank will end its policy of gradual rate increases and instead start slashing rates in 2023. In a speech given in Jackson Hole, Wyoming in August, Jerome Powell fired back, declaring that interest rates were going up and would keep going up until inflation was under control. In the meantime, more volatility and the potential for another sharp decline might be expected in the stock market. Since November 2021, when the Fed made clearer signals about its plans to limit banking sector liquidity, cryptocurrencies have also taken a beating. After months of steady decline, Bitcoin and Ethereum, two of the most popular cryptocurrencies, fell sharply as investors priced in less stimulus and higher interest rates. As the Fed continues to sell off its bond portfolio, the demand for stocks and cryptocurrencies may drop even more. 4. The effect on commodities. Many goods that saw price increases have seen at least some of those increases reversed. Prices for many goods have gone down a lot from their recent highs. This is because of things like fewer restrictions on supply and higher interest rates. For instance, wheat prices skyrocketed in the days following Russia's invasion of Ukraine, but have already returned to pre-crisis levels. Both lumber and steel have seen significant price drops in the last year, with the latter falling by more than 50% from its 12-month highs. Even though the prices of many goods have gone up and down, oil and natural gas, which have fewer supplies and are more important to the economy, have stayed relatively expensive. 5. Credit cards. The prime rate, which is linked to the federal funds rate, is used as a benchmark for determining interest rate changes on many variable rate credit cards. Because of what the Fed did, the interest on credit cards with variable rates will go up. McBride predicts that credit card rates will continue to rise in tandem with the Federal Reserve's rate hikes. Credit card rates, which are already well above 18%, are expected to rise to 19 or 20% in the coming months. Protect yourself from future rate hikes and get on track to paying off your credit card debt by taking advantage of 0% or low-interest balance transfer offers. 6. The U.S. federal government. An increase in interest rates will make it more expensive for the federal government to borrow money and roll over debt, which is already approaching $31 trillion. As anyone can see, the government has profited immensely from the long-term trend of falling interest rates. In periods of economic expansion, interest rates tend to rise, but over the longer term, they have been trending downward. The 10-year and 30-year bond yields are currently trading at levels that are attractive relative to history and substantially below inflation. While interest rates remain low, the government is taking advantage of inflation to reduce its debt load by using today's less valuable currencies to settle older obligations. Of course, that's a good thing for the government, but it's not so great for the people who buy its debt. The approaching U.S. midterm elections may be affected by both high inflation and an unstable economy. People in the United States may vote in ways that experts don't expect because they don't know what will happen. The Federal Reserve has said that inflation is their number one concern and that they will keep raising interest rates until they're sure inflation is under control. The main concern today is how high interest rates will go in 2022, as they have been climbing rapidly so far. How about if stock prices keep falling? For it too, Buffett offers advice. Opportunities come rarely. When it starts to rain gold, don't stand out holding a teacup, instead hold a bucket. For the past year or more, inflation has been soaring, prompting the Federal Reserve to take strong action by increasing interest rates. To take full advantage, you need to strategize how to do so, either by being pickier about where to put your savings or investing your money in certificates of deposit. Well, we think this much knowledge is enough for today. We'll be back with more great content soon, so subscribe to our channel to stay updated. But before that, like and share this video with your friends and family.